Now, if you, like me, want to understand the biggest blown trade in geopolitical history, you don't look at a stock chart, you look at a fish. Bear with me. A fish, because if you poison the water, the fish dies. That's the consensus view, and it makes sense, right? That is the base case scenario. It's logical and it's efficient to believe so. It's exactly how the market is supposed to work. But what happens when you poison the water and the fish? Does it mutate? Does it die? Does it grow into Godzilla? What happens when the target of your hostile takeover doesn't just survive the poison pill, but metabolizes it? In 2019, the United States government opened up the largest short position in history. The target was Huawei. And it's simple. It gave it a liquidity crisis. By cutting off access to US semiconductors, Google, mobile services, et al., and global banking, Washington was effectively issuing a margin call on $1 trillion Chinese company. They were betting that, and understandably so, without US intellectual property, IP, the prime brokerage of the tech world, Huawei's intrinsic value would go to zero. And the market duly followed. Obsequiously, we priced it in, the analysts wrote the obituaries, and the smart money moved directly on expeditiously. But here's the thing about trying to destroy a company backed by a sovereign superpower with a command-control economy. Solvency is not a matter of balance sheets. It's a matter of political will. The United States didn't realize it, but they weren't initiating a controlled demolition. They were setting themselves up for the most violent geopolitical short squeeze of the 21st century. The Huawei trade didn't just fail to print, it blew up the entire portfolio. So welcome to the margin call of the American empire. My name's Justin Banton. This is the House of Trade. Would love it if you could like, share, and subscribe. So let's talk about the American empire and their margin call. And let's do it with a little story. Let's look at the narrative of the shorts. Every trade has a narrative. We know that, right? A lot of us make a lot of money from that. In 2019, the narrative was choke point history, right? Do you remember that? The idea was that the global semiconductor supply chain had specific vulnerable nodes, specific choke points like ASML's lithography machines or Synopsys EDA software. The US believed by weaponizing those nodes, they could squeeze out the liquidity of the Chinese tech sector. And it worked for about 2 quarters. It worked, it did. Huawei's revenue collapsed. Their handset business, which was challenging Samsung for global dominance, fell off a cliff. It looked like the perfect trade. But any veteran trader knows that when a trade looks too crowded, you check your exposure, you readjust, you recalibrate, you take risk off the table. So what was the fatal error the United States made? They confused price with value. They destroyed Huawei's price, their market share, but they inadvertently skyrocketed its strategic value. By banning Huawei, the US stripped away the convenience yield of buying American. Before the ban, Huawei bought American chips because it was cheaper and it was easier. It was pure OPEX, right? Operational expenditure. After the ban, developing their own chips became CapEx, capital expenditure. It became an existential necessity. We forced them to internalize their entire supply chain. I say we, I'm not American, they did it, not me, China. We turned a customer into a competitor. And unlike a publicly traded company that has to worry about quarterly earning calls and dividend yields, Huawei is a private-backed entity of the state that treats semiconductor independence like a war bond, literally. This brings us to the forbidden knowledge sector of my video, the technical arbitrage that the mainstream financial press completely missed, or, let's be honest, are probably paid not to mention. You probably remember hearing about 7 nanometer limits. The narrative was that without EUV, which is extreme ultraviolet, lithography machines from the Netherlands, and well, it is only the Netherlands, China could not physically produce advanced chips. It was a veritable hard ceiling, a physical resistance level to the chart, if we're talking about in chart terminology, right? So when Huawei Mate 60 Pro launched with a 7nm 9000S chip, the market gasped. Mouths were agape. How they said? Did they smuggle the machines? Did they steal the IP? No, they simply arbitraged the physics. It's called multi-patterning. Multi-patterning? Multi-patterning. Yes, multi-patterning. Think of it like high-frequency trading, but for lithography. If you can't print a circuit thin enough with one pass because your machine is old or obsolete, you can print it 4 times. You layer the exposure on top of each other. From a cost of goods sold perspective, this is a nightmare. It destroys your yield curve completely. It's inefficient. It's like trying to dig a tunnel with a spoon instead of a drill. In a free market, this company goes bankrupt because their margins get absolutely crushed and competed away. But China isn't a free market, okay? It's a strategic market. The Chinese government stepped in as the market maker of last resort. They subsidized the inefficiency, they ate the spread, they said, we don't care if the yield is 50%, we don't care if the cost doubles, we'll subsidize it, we'll backstop it, we'll eat it, print those chips. And what happened then? While Washington was laughing at China's inefficient old tech, Huawei was brute forcing their learning curve. Do you know what a learning curve is? Humans have like an 80% learning curve, which means each time we do something, we get 80% more efficient at it. Well, the Chinese brute forced that. They used their old machines to achieve what we thought was impossible. And now, that efficiency is heightened and the inefficiency is disappearing. The yields are stabilizing and they're moving away from survival mode to scalability mode. And the terrifying part about all of this for the incumbent tech giants, Huawei didn't just replace the chips, they replicated the entire stack, all of it. So this is where I have to start talking about the macro setup and how it gets really dark for American equities and more specifically the US dollar. Because the true power of Apple or Google isn't their hardware. It's really not. It's the ecosystem moat that they have built around their entire business entity. It's the recurring revenue from the App Store. It's the sticky user base who are inexplicably loyal. It's the platform monopoly, right? When we kicked Huawei off Android, we thought we were exiling them into the wilderness. Instead, we forced them to build their own walled garden. And the bouquets are smelling delightful and the flowers are growing in abundance and the trees are reaching the sky. So they have a new operating system called Harmony OS. This is like a black swan event for Google's Android. And they ushered it in themselves by supporting US legislation that they didn't really see into the future what was going to happen. Harmony isn't a fork of Android anymore. It's a distinct sovereign operating system. It's not run on American code anymore. Why does it matter for a macro trader like me and possibly like you? Because this is going to create a bifurcated global standard. And you're going to have to decide which section of the walled garden you want to exist on the inside of it or on the outside of it, where one is inflated PE multiples and the other one doesn't even have multiples near to their nearest comp. You're going to have to decide where to allocate for that. For 50 years, the world ran one tech standard. It was the American tech standard. That meant every single digital transaction, every data packet, every royalty payment eventually touched the US system in some shape or form. It was the ultimate dollar milkshake theory, right? It was that guy, Brent Johnson. It was the ultimate dollar milkshake theory. All tech liquidity flowed back to Silicon Valley. Huawei has just built a separate off-ramp pipe, like completely new. Completely separate, no longer linked to the legacy system. If you're a nation in the global south, let's say BRIC members like Brazil, Saudi Arabia, Russia, and you're watching the US weaponize the dollar, and not to mention Russian assets, and the supply chain, what is your hedge? Well, you are going to try and go long on any kind of sanction-proof asset allocation, right? Something that's impervious to being sanctioned. You buy the Huawei infrastructure. It's the obvious play. You buy the system that Washington cannot turn off with a signature or with a precocious or oscillating mood, which is undulating on a daily basis. Huawei is no longer selling phones. They are selling sovereignty as a service. SaaS, get it? SaaS, sovereignty as a service. They're selling a put option against American foreign policy, essentially, right? And the numbers are starting to reflect this. They're starting to be substantial and meaningful, right? They're no longer trivial. They're indeed non-trivial. In China, the iPhone is seeing a massive drawdown in demand. We are seeing a structural rotation out of Western luxury tech into domestic patriotic tech. Apple is losing the China trade for sure, not because their phone is worse, but because the macro environment has shifted entirely from globalization to polarization. So let's talk about the charts. Let's talk about the position. Let's talk about the equities. Let's talk about the setups. How did we get the risk assessment so wrong? And how do we go forward from here? What did we miss? What did we omit? I think personally, we ignored the delta of the Chinese engineer. We ignored the gamma of the state unlimited funding. And we completely underestimated the theta, the time decay. We thought sanctions would kill them off quickly, but the longer they survived, the stronger they got. And their theta, their time decay, was non-existent. Now let's talk about actionable trades, because far too often we listen to people like me, watch people like me, 17 views, and they've like, where's the actual trade, right? How do we monetize this geopolitical mess? If the chip war is over and we lost, where is the alpha now? I'm looking at 3 distinct plays here. You don't have to follow my, this is not financial advice, by the way, but 2 directional bets and 1 macro hedge. Allow me to go through my trades. Trade 1 is on the short side. Put options on legacy tech. I'm looking specifically at Apple, Qualcomm. This is a valuation compression play. I'm not saying they're going to zero, but Apple trades at a massive premium because the market price is a forever growth story, right? Forever increasing prices. But China accounts for nearly 20% of their entire revenue, remember that. If Huawei resurgence continues and the data suggests it is accelerating, Apple isn't just losing market share anymore. They are losing their status symbol premium in the world's biggest luxury market. The trade here isn't long-dated puts or bear put spreads on Apple. You are betting that the China growth story for Apple is completely over. And the market hasn't fully repriced the stock for a zero growth China situation. It's nowhere near priced in at all. The risk reward here is therefore asymmetric because the downside is capped, right? Apple is still a cash flow monster. Let's not get that confused. But if they miss earnings due to China sales dropping 30%, the multiple compression will be gargantuan. It will be biblical. It will be prodigious. It will be highly profitable if you're positioned correctly. Trade number 2. Obviously, we talk about picks and shovels here, okay? Not just the Delta One, but also the derivative play on this. And that is, in my opinion, long commodities. Here's the irony of the inefficient chip manufacturing mentioned earlier. Multi-patterning, that's the method that Huawei SMIC used to make those 7nm chips, is very energy intensive and it's material intensive. It requires more steps, it requires more chemicals, more raw materials. But what really matters is this. China builds completely independent electrical grids, right? And their EV structure is there to support their own autarky, which is their own self-reliance, their own self-determination. So the demand for copper and silver is going to skyrocket. And I think you're already seeing that in the charts. Silver approaching 60, probably going to be triple digits. Copper breaking out, up 5.5. I'm bullish on silver, by the way, if you haven't seen my other videos. And I'm also bullish on copper miners. I'm bullish on all of the miners and the commodity play. This is a supply-demand imbalance. And if there is a trade war or if there is a new technology war, this is going to be inflationary for hard assets, which is why the Bloomberg Commodity Index is looking how it's looking. You can't print silver and you can't sanction geology. You can't do it, okay? Now, trade number 3 is one I've spoken about a lot. It's the sovereign play, long gold. This is a macro overlay to supplement and to complement the other positions. If Huawei succeeds in creating its own non-US tech system that is adopted through the world, it accelerates the de-dollarization theories and the trend going forward. If the US loses control on the digital rails, the premium on the dollar weakens. Central banks are already buying gold at record paces. They are hedging against the weaponization of the US financial system. I don't need to go any further on why gold is a strategic play in this point. And I'm pretty sure most of you agree that the dollar is egregiously overvalued. I mean, Goldman Sachs, JP Morgan, they all agree, okay? So let's circle back to the narrative for the close of this video. There is a concept in trading called capitulation, right? Max pain, death, closing positions, acquiescence, margin calls. It's when the pain becomes too great and you are forced to close your position at any price. The US government currently is in that denial phase. They are tightening sanctions, they are investigating SMIC, and they are issuing stern warnings. But the market knows the truth. It always does. The smart money follows the volume and it sees the capital flows. Huawei in 2019 was a different beast. The one that simply assembled phones using American parts, that company's dead. It's gone. It's not coming back. We successfully killed it. Mission accomplished. Well done, guys. But in its place, birthed a vertically integrated, absolute monolithic monster. A company that mines its own silicon, writes its own code, builds its own AI clusters, and drives its own cars. We tried to checkmate them in 2019, but we forgot to check if they were playing chess. Turns out they were playing Go. And while we were capturing their pawns, they were surrounding the entire board. So Huawei, which I call the unkillable giant, isn't just a tech company anymore. It's a signal that the era of unipolar tech hegemony is well and truly over. The trade has reversed. The question is this: are you still holding the bag of old world order? Are you still heavily allocated to old world market theology? Or are you moving on and positioning for the new one? 2.0. Markets closed, video over, good luck, happy investing. I have nothing more to say. Ciao for now. Bye-bye.